Welcome to the On the Horizon podcast, buying and selling businesses, brought to you by Horizon Business Brokers, your trusted guide to buying, selling, and valuing businesses. Your next opportunity is just on the horizon.
Hello, and welcome back to On the Horizon. I'm Dustin Zaire, and I have a very good friend of mine and my personal accountant, Brian Nichols with Mendelsohn. How you doing today, Brian?
Doing well. Thanks, Dustin. Thanks for having me.
Awesome. Glad you can make it today. I want to give you the opportunity to first introduce yourself to our guests, tell them a little bit about yourself, what you do, and your firm, and then we can talk shop, talk about the differences between bookkeepers and accountants and different types of financials, kind of strategy to prepare yourself to sell your business if you're a business owner looking to come to market anytime between now and whenever you might be ready, if that's 3, 5, 10 years from now. So Brian, go ahead, tell us a little bit about yourself and Mendelsohn.
Sure. Thanks, Dustin. My name is Brian Nichols. I'm a CPA and a tax partner with Mendelsohn and Associates. We're located in Fairfax, Virginia, and we also have an office up in Baltimore, Maryland. I'm on the tax side. I deal a lot of tax planning, tax strategy. We do the tax compliance for businesses and individuals, as well as trust and estates and nonprofits. So a little bit of everything. So yeah.
Awesome. Thanks for sharing a little there. The age-old question. What would you consider to be the main difference of a bookkeeper, an accountant, and a tax advisor? And how do they potentially all work together?
Sure. A bookkeeper kind of does the daily transactions for a company, recording AR, AP, doing payroll, doing bank reconciliations, credit card reconciliations. They're basically maintaining the day-to-day records for a company. They're basically focusing on the accuracy and completeness of the data in the financials. An accountant kind of is probably the next step up. They're usually interpreting and adjusting those financials, could be preparing financial statements internally. They're focused more on the credibility of the numbers, making sure that they're right. And then myself as a tax advisor, we usually take that data, those financials, and we help in a transaction situation, help structure the best way from a tax strategy to structure the transaction. We can model after-tax outcomes, whether you decide to do an asset sale or a stock sale. And then we can identify planning opportunities for the transaction as well. So we're really focused on optimizing our clients' after-tax proceeds and mitigating risk, if you will. We as CPAs, we also do quite a few other things. We also can do different kinds of financial statements that are not internal for businesses as well.
Okay, no, that's great. So it sounds like if you're a business owner, you really need all three of these professionals to be able to help you make sure that your books are in order for your operations, make sure that you're properly filing your tax returns, getting all the tax incentives that are available with all the various tax changes that happen annually, and then having a good tax advisor. So when you are selling, that you're going to have the best taxable situation for yourself when calculating your capital gains, because things are taxed differently, right? When you're selling a business and you're allocating your purchase price, things get out, your part of your purchase price gets allocated to your tangible assets, inventory, goodwill, non-compete. And it's best to have an accountant and tax advisor on your side to make sure that you're going to have the best taxable outcome, to put more money in your pocket versus putting more money in Uncle Sam's pocket. So I've been selling businesses for 20 years, and we have buyers that are always asking during due diligence, I'd like to see audited financials. And, for most businesses, you don't typically see audited financials. Typically, a lot of your larger businesses that have maybe like government contractors or publicly traded companies might have audited financials, but most other small businesses typically have like internal financials or just compiled or reviewed financials. Could you help us understand the difference between internal, compiled, reviewed, and audited, and when they're typically used or expected to be seen?
Yeah, sure, certainly. So internal financials are typically just the books as they are. Maybe they're looked at by an accountant, but usually they're just the financials that a company is keeping internally. Usually it's done, every company usually keeps their own books, but from a transaction standpoint, it's usually the lowest level of we'll say assurance, if you will. If a buyer is looking at a certain company, there's no outside set of eyes looking at those financials. They've kind of a buyer's got to take the seller at their word. And then as a CPA firm, we offer certain levels of financial statements, and each one has a different level of work, if you will. The first level is called a compiled financial statement. That's pretty much us as an outside CPA firm looking at your internal financials, not really doing a whole ton of work, and just making sure that they're clean. We're not really providing a whole lot of assurance on a compiled financial statement. Usually there's pretty low amount of credibility, but more than internal financials by themselves, because they're at least getting a second set of eyes on the internal financials. That's the lowest level of financial statement that us as an outside CPA firm will provide. Typically, the next level is called a reviewed financial statement. That is another financial statement that's provided by us as an outside CPA firm. We provide, assurance that the numbers are, have been looked at, that everything looks right. We are still doing quite a bit of work on a reviewed financial statement to make sure that the numbers are right and everything in there is on the up and up. And from a transaction perspective, it does provide a pretty reasonable amount of credibility for the buyer, knowing that an outside CPA firm has reviewed the financial statements, and we're signing off on the assurance that those financial statements are correct. I would say a lot of the financial statements that we do are typically the reviewed financial statements in the middle market. Most of the time, those engagements still take quite a bit of time because there's a lot of data and correspondence that goes into those reviewed statements, but they do provide a pretty reasonable amount of assurance for a buyer in these transactions. And then audited financial statements are the highest level of assurance that an outside CPA firm can provide. We're doing a lot of the same work we would be doing for a reviewed financial statement, but it's a lot more work and a lot more involved, a lot more detail. Typically these are for larger clients who need a audited financial statement for various reasons. Usually it's a bank, or maybe they're, they need it for insurance purposes. But the audited financial is the highest level of assurance that we can provide as an outside CPA firm. And in a buy-sell situation, it does provide the highest level of assurance to the buyer, that these financials are, indeed correct.
Cool. Thanks for sharing. Yeah, that's very helpful information. So our community can understand, hey, if I have a business that maybe only doing, say, $500,000 to maybe $1 million or less, you're probably still going to see internal, maybe some compiled financials there. But I would say, correct me if I'm wrong, but maybe in that $1 to $5 million revenue range, or even enterprise value, you'll start to see, again, definitely compiled statements, probably some reviewed statements. And then as you move upstream into that kind of lower middle market range, and that 5 to 10 million plus in revenue and or enterprise value, that's when you'll see reviewed for sure, and maybe even those audited statements.
Yeah, that's correct. Typically it's based on revenue of the client, enterprise value, how big the deal is going to be. A lot of the time it's if the buyer needs that level of assurance, depending on what the industry that the company they're purchasing is in. So sometimes internal and compiled financial statements are probably fine for less than $1 million, but as the companies are growing and getting larger, a lot of the time they'll want to see either reviewed financial statements or sometimes audited. But yeah.
Yeah. Cool. All right. So moving on, in a business transaction, you typically have two different sale types, right? You have an asset sale or a stock sale. Could you explain the difference between the two and why one or the other may be more favorable to a buyer or a seller?
Absolutely. Yeah. Typically, buyers prefer asset sales. So what happens with the asset sale is the buyer's purchasing the individual assets of the company. And what they do is they get a step up in basis to fair market value. A lot of the times, if the purchase price is higher than the values of the assets, then the rest of the purchase price gets allocated to something called goodwill, which also can be amortized. So essentially, with an asset sale, a buyer can recoup the cost of the purchase through depreciation and amortization over a period of time. That is highly preferential for buyers. And then for sellers, it's not as preferred, typically because when they sell assets, the allocation of those assets can get thrown into different buckets. Some of the purchase price will get allocated to ordinary income assets, also known as hot assets, accounts receivable, inventory, regular cash producing assets in the ordinary course of business. From the sell side, those get allocated to ordinary income when we sell an asset sale. A lot of the rest of the stuff gets thrown into capital gain, but in that regard, there is that certain split from the seller side on an asset sale. On a stock sale, that's usually preferred by the seller because you're just selling the stock in a company. Just if you held stock when your brokerage accountant sold it later on, that's capital gain treatment of the lower preferred rates for the capital gain. But you don't typically have there's no ordinary income being picked up in a stock sale, and it's typically cleaner. There's not as much work involved with stock sales, but again, from a seller perspective, it's all capital gain, and that would be the preferred side from a seller standpoint. From a buyer standpoint, buyers typically don't want to buy the stock because they get no step up in basis. They don't get that recoup of their costs as they do through an asset sale. A lot of the times in transactions, it's a negotiation between the buyer and the seller to get to the preferred transaction type. From a tax perspective, obviously, a stock sale would be great for a seller, but on the buyer side, they're not getting what they want. So there's a lot of back and forth when transactions are occurring.
Yep. No, that's very helpful. And I'm going to throw a little bit of a curveball at you. So when you have a buyer that really wants to buy the corporate stock or the entity because maybe there's contracts that business has that aren't assignable, so it's easier and cleaner to do that stock sale to be able to transfer those contracts. The seller is happy because they're having a lower tax liability. But if that buyer maybe has good counsel, and maybe it's not a one size fit all for all situations, but there's something that's called a Section 338H election, right? That kind of allows a buyer to purchase the stock of a company but treat it like an asset sale. Can you explain? Maybe I explained it clearly enough, but could you expand on that a little bit and how that can really be a good solution in some cases?
Yeah, sure. A lot of the times, especially with kind of government contractors where the contract has to stay with the company, a 338H10, effectively you're effectively selling the stock of the company, but it's treated as an asset sale. So the legal form is a stock sale. So you're selling the stock, but for the tax treatment, we're treating as like a deemed asset sale. And there is a lot of structuring involved with these, but typically it's a best of both worlds because you're still getting the buyer is still getting a step up in basis as if it were an asset sale, but the contracts that could be associated with the transaction are still there with the target, and then can get passed along to the buyer. So that's there's a lot of nuance to 338H10, which you can certainly reach out to me at another time and reach out and we can get that all figured out for you if that's the right strategy. But maybe it's a little bit too high level for this conversation.
Yeah, no, I just wanted to say that there's other options, right?
Absolutely.
There's asset sale, there's stock sale. You can potentially get the best of both worlds. For our audience out there, if you're going through a transaction, you want to learn about the different options, feel free to reach out to me or Brian so you can see what your best path is going to be. Okay, so in your opinion, when would be the best time to involve an accountant if you're looking to sell your business?
So I think it depends, but I think the optimal amount of time would probably be 2 to 3 years before you're looking to sell would be probably the best time frame. Obviously, the sooner the better. Always the more time that we have to plan and get things all lined up is preferred. I would say at a bare minimum, like a year out, just because a lot of things need to happen in a transaction and a lot of things pop up during due diligence that with effective planning and cleaning things up don't become issues further down the line. A lot of the times when if we have enough time ahead of the transaction or before potential sale, we can clean up things that might pop up during due diligence ahead of time. So it saves a little headache once you get into that diligence phase. But having proper planning certainly helps with the whole process.
Agreed. So that's my next question. In planning, and when sellers are generally most concerned about, hey, I might sell my business for $1 million, but after I pay Uncle Sam, whether that's an asset sale or a stock sale, and I'm going to pay whatever it is, 15, 25, 30+% in capital gains. What are ways that you can legally reduce your tax liability, right? So we talked briefly about stock sales are going to give you a better treatment. We talked about a 338H10 potentially. There's another election, a 336E election, which we don't need to go into detail with. But what are some other ways that a seller can reduce their taxes, and how far in advance do you plan to do that? I'd imagine still that same 12 to 36 months, but maybe there's things that take longer.
Yeah, it depends on a lot of factors. Each company is set up differently, and if they're a partnership versus if they're an S corporation or if they're a corporation like a C corporation, there are different strategies that can be involved. I would say one that can be done, one of the best ones I think is probably like an installment sale, meaning when a buyer purchases the company, the seller can spread out the gain over a period of time, over several years, to not get hit all at once with a huge tax bill. That's one that we see quite frequently. A lot of the times, if it's an asset sale, we do purchase price allocation between the different kinds of assets and the different types of assets. If you've got a lot of AR and inventory, as I mentioned before, those are called hot assets. So those get taxed at ordinary rates. Maybe prior to selling your company, reducing that as much as possible so you're not getting hit with ordinary income tax rates on the sale. That's another strategy that's certainly been used. But I think it's a facts and circumstances planning situation. So every single transaction that I've ever worked on has been a little bit different. There is no cookie cutter way to do this. So it is best practice to have a tax advisor on your side to help you walk you through the different kinds of scenarios, different planning opportunities that are out there.
Yeah. So is the installment sale, that's kind of seller financing, or an earnout could be bucketed into an installment sale because you're not getting all of your money at one time. It's spread out over a period of time, right?
Yeah, typically when it's seller finance, that's kind of how we would structure it if it's over a period of time, especially. That's certainly one that we see quite a bit.
Okay. And just speaking of earnouts and seller financing, aside from for the seller to be able to shift kind of their tax liability, it also, would you agree, kind of helps shift a little less risk to the buyer, right? So if it could help maybe bridge some small valuation gaps, if you have high customer concentration, if you have an earnout that might be tied to customer retention. So there's ways to limit your risk and liability for both buyer and seller, kind of using those avenues, right?
Yeah, it's typically with the earnouts and the seller financing, you're shifting a bit of the risk a little bit more to the seller. The buyer is really going to control the performance metrics, if you will, on the of what's going on with the company after they purchase it. It does, like you said, it does kind of shift the risk a bit, but that's certainly part of the negotiation part in transactions. But we see earnouts quite frequently in a lot of the transactions that are happening nowadays to give a little bit more sweetener, if you will, to the seller. But a lot of the times it's associated with the seller staying on and being part of the management team during transition, but having those employment contracts in place to make sure that all goes along smoothly. So, but yeah,
Yeah.
certainly.
Cool. Yeah, I'm seeing a little bit of that as well. Again, depending on the size of the deal and the infrastructure that's actually in place. Because in a small business, and a more of a main street business, I don't really see a lot of earnouts, but I do see and hear earnouts and kind of that, what I would call the upper main street, in that $1 to $5 million range, or certainly in that kind of lower middle market, marketplace, $5-10 million or more. So there's sellers seem to be a little bit more open to it there because they know that there's more infrastructure with their employees to be able to maintain customer retention and continued growth, and it's not going to be solely on their responsibility or the buyers, right? Let's talk about one or two more things, and which I think would be helpful for a lot of our audience to know: working capital, because it's probably one of the most misunderstood levers in a transaction. I'll start off by saying that in my 20 years of experience, most of the transactions that I would say that are sub $1 million in enterprise value, or very close to that, typically there's not any or a lot of working capital included in the transaction. It's expected that the buyer that's purchasing the business brings their own working capital from their own cash, or if they're getting an SBA loan, the SBA lender is packaging working capital into the loan. Are you seeing that as well, or not? And then what's what does our audience need to kind of know and understand about working capital?
Yeah, I think you're spot on there. I think probably with smaller deals, there's probably not as much of a emphasis on doing a net working capital adjustment. I think a lot of the deals that I work on do seem to have a net working capital adjustment component to them. When it's depending on the company, some of it, if it's a cash intensive business, if you take out the cash, obviously, but net working capital is current assets less current liabilities. It's not typically like a closing adjustment to the transaction, but can be a dollar for dollar adjustment to the purchase price based on what that looks like. And a lot of the times, what I've seen is that typically there's a target that's like a target net working capital number that's negotiated ahead of time to include in the transaction. And then typically after a certain amount of time after the transaction, you look at the actual numbers and you kind of true up what that net working capital is, but it certainly can swing the final transaction amount to be a different number than originally thought. It definitely comes into play a lot more with the larger transactions, I would say over $5 million.
Yeah, for sure, most certainly. Thanks for providing some extra clarity there. All right, so in your opinion, what would be one or two red flags that would really kill a deal? And then what are one or two things that, that you would give your best advice for before selling a business?
Sure. Yeah. Things that would certainly kill a deal would be unreliable financials, bad books and records, no record keeping, or having unknown liabilities certainly would be issues. I think having clean books and having, or even compiled, reviewed, or audited financial statements certainly help provide clarity to a buyer in a lot of situations. With internal financials, a lot of the time, even if you don't have a bookkeeper and you're doing them yourself, the reliability on what's actually in there is at a pretty low. So keeping good records, financial records, I think is paramount. I think another thing could be if there's a key, if your market is concentrated in one specific area, there's some risk there. If your business is heavily saturated or based on one key employee, there's also a bunch of risk there. So there's lots of red deals, but I would say the number one would be unreliable financial data.
Yeah, I agree. And then, that key person dependency, key employee, whether that's you as the business owner or just a superstar employee, and then having a customer that makes up 10 to 20% or more of your revenue could raise some concerns for buyers as well. To wrap things up, what's your best advice for selling a business and planning ahead?
Yeah, I mean, I think getting a good team around you to help with the transaction, and starts with planning 2 to 3 years out. Talk to a tax advisor, make sure you have an attorney lined up to strategize the projected sale. Make sure you're cleaning up your books and records, getting those all in order, getting them tidied up, and making sure that the numbers look good. Because then once you go to market, once you get to due diligence and a letter of intent is getting close to be filed, and there aren't any surprises, right? Everything has already been reviewed and looked at, and you have a known structure, and you know what your tax outcome is going to be depending on the negotiation. But getting everything planned and buttoned up ahead of time is certainly something to be done.
Yeah, definitely. And I would say, wrap things up, great exits are not always just won in negotiations, right? They're earned in the years before the sale by removing uncertainty. Buyers pay a premium for clean numbers, trustworthy sellers, predictable cash flow, and an understandable risk. They will walk away from confusion and uncertainty and a seller that's untrustworthy, right?
Absolutely.
Get everything together, cross your I's, dot your T's, make sure you have professionals in your corner, the bookkeeper, the accountant, the tax attorney, the business broker, M&A advisor, the M&A attorney. We're all here to assist you. So, Brian, I'd like to thank you for your time. Before we let you go, please share with our audience, again, your name, your best telephone number, and web and email address for you, and so they can get in touch with you.
Sure. Yeah. So Brian Nichols, CPA, best contact number is 703-592-7200. My email address is bnichols@gma-cpa.com.
Awesome. And the web address is www.gma-cpa.com. Brian, thanks again. I appreciate it. I know you have a busy day. You're getting out of tax season here, so we're going to let you go. But again, I'm glad you could make it today and help out our guests and educating them. And I look forward to talking to you again soon.
Absolutely. Appreciate it, Dustin. Thanks for having me.
Thanks, Brian.
That wraps up this episode of On the Horizon podcast, Buying and Selling Businesses, brought to you by Horizon Business Brokers. If you found value in today's episode, be sure to subscribe, leave a review, and share it with someone ready to take their next step. For more resources and personalized support, visit www.horizonbrokers.com or call 703-910-7384. Thanks for tuning in. See you next time on The Horizon, where buying and selling businesses creates opportunity.